the people get to make a little bit of money. We get to visit those businesses, help them out, see them grow, and we can divest from the ones that we don't want to support. So that's what CoCap is all about. We're super excited to talk about the ways in which to do that today. And let's see, what do we have left? A couple more things. One, you all have index cards on your chairs. That is, in spirit of everyone being an investor, we have a session this afternoon called Everyone's an Expert. So if you have questions that you're coming in with today, or that you come up with during the day, take these cards and put them over where it says
economy. And it's Marco Evangelisti, who I am just really, really happy that Marco was able to make this work and be. So that tells you who he is. Since 2009, he has been engaged in what we are all calling the Great Turning, meaning that he works with the Slow Money Network, and he's basically been able to simplify very complex systems into a way that the public can understand it, and he's sharing that knowledge widely so that we all really get what is going on, because most of us really don't know.
Well, thank you, Conda, for inviting me here. And what I'm going to do is share with you my personal journey from conventional finance to slow money and what I call regenerative investing. And here's what I'm going to talk about. The other one is I want to convince you, when we say about 100% of the people need to be invested in the local community, I'm also saying 100% of their investments need to be the right kind of investments. Because business as usual investing is no longer an option, and I hope to convince you in the next 30 minutes that that's the case. And then I'm going to I have to take you through a little bit of a dark material. I warn you for a few minutes. So if you see something a little bit hard to take in, big breath, exhale, and know that I'm not going to leave you there for too long. And the positive thing is there are 4 trends that are going to make our work easier. Because right now it's pioneering work and it's really hard, but it will get better. Thanks also to Jenny Casson and everybody in this room. And then we'll see what can the person in your seat actually do about it. And I'll give you basically a preview of local investing tools and current models, and the panels and Jenny Casson and all the other speakers will go more in depth with that. My personal journey started about 25 years ago when I was studying finance. Don't be scared about this chart. All I want to say about this is that it's premised on, it's a very iconic construct of conventional finance that is premised on the fact that all you need to know to make an investment decision is what is the risk, the return, and the liquidity of that investment. Liquidity is that how fast can you convert that into cash. With the understanding that the higher the return, the better, the lower the risk, the better, and the higher the liquidity, the better. And that's all you need to know to make an investment decision. All your financial advisors will basically focus on those 3 things. This is what I call the narrow lens of conventional finance. And after 6 years of theoretical math, this actually looked like the real world to me. We're talking about real stuff. Well, it turns out that the real world looks more like this, right? And in order to understand this tree, you really need to understand it as embedded in a dense network of relationships. It's something alive, is in a relationship with our own breathing, as you know. It's in a mycorrhizal relationship with the fungi in the soil, with which it exchanges nutrients. It's in a relationship with the soil. It basically anchors it and builds it up by shedding its root filaments. And finally is a habitat for a lot of organisms. And yet, if you look at this tree through the narrow lens of conventional finance, this is all that you can see. Finance can only see the commodity value of lumber. And another way of saying this is that according to conventional finance, a tree is worth more dead than alive. This is a dead tree. And it is exactly this that allows us as humans to transform a place that looks like this into a place that looks like this, right? And this is a very painful image. You can react in various ways. One way you can say, what that is completely a waste, right? Whatever economic benefit was derived from this operation, it cannot possibly capture the true value of something like this. Or you can think about the injustice. This is basically something that has been built over hundreds of years, is a common that is available to future generations of humans and to millions of organisms, and now they don't have it anymore because a few people benefited from that transformation. But if you think about this from a finance standpoint, if you were able to buy this forest for $10 million and sell the wood for $12 million, you would have gotten a 20% return. If you did that within a year, but if you managed to do this transformation in 6 months, you would have gotten a 40% return for your money. And if you did it in 3 months, you would have gotten an 80% return annualized. Remember what I said at the beginning, the higher the return, the better, right? And so you can see that there was some certain haste involved in this transformation. And it's interesting because it is exactly a transformation of this sort that got me to leave the finance industry. I was actually working for a very well-respected and ethically run investment management firm. And I was part of a team managing about $20 billion worth of equity investments in emerging markets. And we were managing money primarily for foundations and endowments. And I remember looking at one of the best performing stocks in the portfolio was a palm oil company in Malaysia. And I looked a little bit closer and I found out that they had taken down tens of thousands of acres of original rainforest and replaced it with a monocrop of palm oil plants. And part of their amazing revenues that year was the carbon credits they earned for planting trees. And I remember talking to the chief investment officer of an environmental foundation. And I said, are you not concerned that the money of your foundation is invested in a company that is just taking down the habitats of these guys, and your foundation is trying to protect that habitat? Right? Fair question. And he basically said, well, you know, my job is really to protect the assets of the foundation in perpetuity, a luxury, by the way, not afforded to the 1,000-year-old forest. And I have to generate some return to pay for our expenses and the programs of the foundation, which is trying to save the habitat of these guys. And that's when I realized this system is set up in such a way that even rational, well-meaning, ethic people end up doing something so destructive at the end of the day. And that's how I left the industry, not an easy thing to do, in 2009. And I started looking at these large systems, and that's how I developed the essential knowledge for transition. And one thing I realized is that money, including investment capital, is less real than we think. When we get those statements from Schwab or Fidelity, we see a number there, and we think that's real stuff. It's our money is somewhere doing something, right? And I want to convince you that those numbers are less real than we think. In other words, I want to raise in your mind the sense that current investing is more risky than we actually think it is. And there's a long story about it, and I cannot tell you, but all the investment capital that you see out there, at the end of the day, was generated by the banking sector through loans. It's an expansion of balance sheets. I cannot get into that, but that's the original way in which money enters into the system. And so just to get a little bit of a sense for how real are those numbers, world GDP 2 years ago, $70 trillion, big number. But global financial stock, just bonds and stock markets around the world, $212 trillion. This is called the financial intensity, which is the ratio of financial assets to real GDP, has increased a lot in the last 50 years. It's now 3 times the level of GDP, and it's growing. Or let's look at derivatives instruments. You might have heard about CDOs and interest rate swaps and other things. Well, there are about 1.2 quadrillion, so 1,200 trillions of those instruments, 17 times the GDP of the world. How real are those numbers? But to make it a little bit more concrete, I want to you to look at your investment portfolio and your mutual funds, and I guarantee you that you probably, if you have a well-diversified portfolio, own some oil companies. And now I want to, again, big breath, let it go. If it is a little bit scary, I know 5 minutes you have to hang on with me on this. You know the terrifying carbon math, which is basically 2 degrees Celsius, we can raise the temperature of the planet more than that from pre-industrial level. Otherwise, global ecosystems starts unraveling to the point where they can no longer support human life. So it's a pretty important number. 560 gigatons of carbon is what is computed we can still put in the atmosphere before breaching that limit. That's about 13 years from now, current emissions. And 2,800 gigatons of carbon, what we already have in the known reserves of the fossil fuel companies. We have not rocked with this concept as humans, nor has the market. The market believes those companies are worth in the hundreds of billions of dollars. The assumption is that they can burn all those assets and find some more. But we know 80% have to remain stranded in the ground. So there are 2 possibilities. We do the right thing and we stop after just using 20% of what we already have, in which case these market capitalizations are not real. Those companies are worth much less. Or we don't stop, and then let me ask you, what is the market capitalization of these companies on a planet where humans are not capable of surviving? Right? You get my point? Part of your portfolio does not exist. The market has not recognized it yet. Let me give you another example. I know this is hard, and then we go into the positive stuff. So there was a study, neoclassical economics does not recognize the things that are provided for free by nature. So nature happens to provide us with, water, land, natural resources, and so on, for which we don't have to pay, right? Even the gasoline, the oil that we find in the ground, nature does not charge us. It's just the cost of us extracting it. And so a branch of economics called environmental economics has tried to put a price on the natural capital that we use for free. And at the end of a massive study that concluded in April 2013, sponsored by the UN, called the Economics of Ecosystems and Biodiversity, they measured basically unpriced capital in the form of water use, land use, waste, land and air pollution, and greenhouse gas emission, and put a price on that. And then they looked at the world activities and the economic activity around the world. And specifically, they looked at something called region sector. A region sector is an economic activity in a geographical area. So for example, coal power generation in Eastern Asia. It's a sector on a particular region. Or cattle ranching and farming in South America. And they basically asked, what was the unpriced natural capital that has been used by that activity? And what was the revenues that that sector generated? And so if you look, I know you can't look at those numbers, but I'll read them off just for cattle ranching and farming in South America. The natural capital cost was $312 billion of natural capital for which they did not pay, and they generated $16.6 billion selling beef to McDonald's and Burger Kings and so on, right? So in other words, we are converting a lot of natural capital that we don't have to pay for in revenues. And in fact, if you look at the whole world, the top 20 impact region sector used $3.2 trillion of natural capital to generate $2.4 trillion of revenues. We're taking something that is worth 3.2 and selling it for 2.4 and call that economic activity. Worldwide, basically, we're talking about $7.3 trillion worth of natural capital being used every year for economic activity. Why is this important? It's important because we're using nature as a business in liquidation. And we're selling off its assets and call that revenue and economic activity. And I guarantee you, again, if you go back to a well-diversified portfolio, a lot of those economic revenues and the financial returns that accrue to them are extractive in nature and come at the cost of the natural capital. And so here we have a little cartoon just to put a little bit of levity, and then I'll take you out of this dark spot and show you where we need to go. Yes, the planet got destroyed, but for a beautiful moment in time, we created a lot of value for shareholders. That is where we are right now. I think understanding the role that our investments are playing in building the world of tomorrow is our existential challenge. We need to wake up to that. And I want to introduce you to this little cute creature here called a tardigrade. A tardigrade is this amazing little guy, it's about 1 millimeter long, and it can dry up and be completely dried without water for decades. And then you drop it into water for 15 minutes and it comes back to life and starts moving again. And when it's all dried up, you can blast it with 2,500 times the level of radiation that would kill you, and it will be just fine. And it has been found alive and kicking in temperatures between minus 50 degrees Fahrenheit and plus 300 degrees Fahrenheit. Why am I talking to you about this guy? Because one idea that you need to get out of my talk, if you get one thing out of it, is that our investments of today are building the world we will be living in tomorrow. So if you happen to be a tardigrade, then your investment portfolio is perfectly positioned to create the conditions where you will be comfortable in retirement. But if you're not a tardigrade, then you have to pay attention what type of world your investments are creating. And yet I have a confession to make. 3 years after walking out of my job and leaving behind a nice fat paycheck, my money was still invested in the extractive economy. And I say, why the heck did it take me so long, given the fact that my personal cost of, let's say, liquidating my investments versus leaving a job. I mean, a job was a much bigger financial hit for me. And yet it took me an additional 3 years to let go of all my investments and start investing in the local economy. And I think it has to do with the strange power that finance has, especially in this very intermediated and global system, to sever our intentions and values from our agency in the world that is expressed by our investments. We act in the world through our investments. And this is our challenge, is basically to reintegrate our own beliefs, our own sense of compassion and empathy with our investment practice. And that's what we're here to do. So this is my moral compass now for investing. And the funny thing is that it took me, once I made the decision, 30 minutes to liquidate everything, right? Because that's, all the investments now, the funds, the stocks, you can sell them like that. So that's actually very easy. The hard part is actually investing that in the right thing. But anyhow, I start actually with biophilia, which is the innate love that all living beings have for other things that are alive. And I ask myself, is this investment supportive of life and ecosystems, and is it respectful of communities and their labor and their work? And if the answer is yes, the second thing is I establish a relationship with the entrepreneurs, their needing capital. Are they also guided by a moral compass or not? Why are they doing what they're doing? And only after establishing a personal relationship, I might consider an investment in them. And yes, it takes time, but that's how I am doing now. I mean, all my money is out of Wall Street, anything that trades, and it's all in things I know completely, including RSF Social Finance, Social Investment Fund. You have complete transparency because you see where that money is used, and other direct investments that I've done mostly through slow money. So I would say let's invest as if life mattered, but this is a big call. So the good news is that there are now 4 trends that are expanding the options for regular folks to make direct investing in their communities and in the type of things that build the world they want to live in. And the first one is the social enterprise movement. And I would say Impact Hub Oakland is a nexus that is trying to support and launch a lot of social enterprises. So the social enterprise movement is basically a new generation of entrepreneurs, most of them young but not exclusively, that realize that they don't want to be part of the extractive economy, that they don't want to work for a big corporation doing the things we've just seen. And they want to use the for-profit model to solve environmental and social problems. And yes, the entity needs to be profitable, but profit maximization is no longer what drives it, right? It's just a way to keep going. The other trend is impact investing, which is what I have been experiencing and talking to you, and CoCap is a great venue where impact investors are coming in. And that's basically investors that recognize that they have to look beyond the narrow lens of conventional finance. They have to look beyond the risk, the return, and the liquidity, because just by doing that, we're destroying the planet and communities around the world. We have to look at the non-financial impacts of our investments. And I hope that this will grow and that you will join the movement. The third one is, as Jenny Casson will explain, asking for money to your community is complicated by securities laws that were put in place to protect people that couldn't protect themselves. But now it's really hard to go out and ask your community for support. So there are various avenues that we will explore. The DPO registration, which is a little bit an easier way of doing, doing that. And the other one is the crowdfunding, the Jobs Act and the crowdfunding laws that are being passed both at the national level and at the state level. They're very exciting. This will allow people to make direct investment using platforms. And finally, the local first movement, right? We've understood the importance of buying local, shop local. We also need to start investing local. So at the confluence of this trend, there is the possibility of shifting the trillions of dollars of financial assets in the United States and build sustainable, healthy communities through local investing. That's really the call of our time, and we have to wake up and do it. So what can the person in your seat do, right? Because at the end of the day, you can hear me talk, but you have to do something about it. So first thing you can do is move your money from the large banks to local regional banks and credit unions, including the two sponsors that we have, New Resource Bank, and what is the new name now? Is the State Benefit State Bank or something? Beneficial State Bank, right? And other credit unions. Because when you move your deposits, you're actually increasing the ability of those entities to make loans locally. And I tell you, the large banks are no longer interested in making loans to the local community, even if they say so. It doesn't make sense from their business standpoint. Local banks, regional banks, and credit unions are doing that more. The other thing you can do is join a CSA. It's a way of financing food production. You can prepay for your favorite food purveyor through Credibles, and we'll talk a little bit more about that during the day. You can join a local slow money group. There's a very active slow money group here in Northern California. That's how I found my way back into finance, if you want. And I'll talk about that in the next couple of slides. You can explore DPOs that are available in your state to invest, and Jenny will talk more about that. You can park some money with RSF Social Investment Fund while you decide what to do with it, or you can leave it there. And you can explore currently available platforms that are coming up now like, for example, KivaZip, Community Source Capital, Fundrise, and so on. And if I have time, I know the timekeeper is going to be keeping me honest here, but I might mention those. So I just want to give you a little bit of an idea of what slow money is, which is really, when I walked away from finance, I thought I would never be involved in it again, and now slow money kind of brought me back into the fold. And I'm doing a completely different types of finance and investing. So the way forward is really to relocalize and democratize the investment process. These are 3 great books that will get you started with that. And I just want to talk about slow money, which is something that comes out of slow food. Woody Tash wrote this book titled Inquiries into the Nature of Slow Money, Investing as if Farm, Food, and Fertility Mattered. And it's based on a recognition that both our financial system and our food system in this country are fundamentally broken. And we can fix them from the ground up by investing in real places, real people, in your community, starting with food. And the idea is to measure success by the things you create with those investments, not just by the financial return you get out of it. And so there is a series of principles, the first one of which is we must bring money down to earth. And a number of groups around the country organized, self-organized around those principles and started making investments happen. And I will just give you a couple of examples here, and then we'll focus more on the local examples during the panel. But there's a case in North Carolina. There was a co-op that had a large loan from a bank for 8.75% that was going to be due. Balloon payment was due in a year. And they were, struggling to make it happen. It's basically the center of town. If you want to meet someone, you go to the Chatham Market and eventually you're gonna run into them. Not only that, it provides an avenue for all the local producers, farmers, and so on. And so this actually risked going belly up. So a group of slow money investors came together, refinanced, basically bought the loan from the bank and refinanced it at 5%. And so the investors got 4%, there was a 1% for the management and the LLC and so on. But basically they got a 4% return. They got their market that is still there, the center of activity, the support for all the food vendors and food producers they love, right? So they get a return that is in part financial, in part is all the other benefits of having this place there and not, a big supermarket chain replacing that. This is an investment I was involved in here in Northern California, Cape Valley Farm Shop. We raised $82,000 for them. They are building basically a food hub, aggregating the produce of more than 30 farms in the Esparto area, Cape Valley, and delivering CSA boxes. That was really a fun project. And then another model that has been used around the country is this idea of the investment clubs. A bunch of people come in, put in $5,000 into an LLC, and then collectively people decide how to lend this money out. It was pioneered in Maine by the No Small Potato Investment Club of Maine, and they made more than 40 investments now, and there are 20 members each putting $5,000 in. So then we'll talk a little bit about the platform. Credibles is another platform where you basically prepay and therefore finance the operations of the food entrepreneurs that you like. And I'm sure you'll learn more from Arno, and we'll talk about these platforms. We have now, Cutting Edge X, and I'm sure that Jenny Casson will talk about that. And these are local investments that are registered, so available for everybody to invest in. And they are, if you're in Californian enterprises that you can access this with. The what? I know, but if you're in California, you only have access to the California one. Yeah? Okay. Since we're in California, that's where we are. And then we have Kiva Zip, which is kind of zero-interest loans. They kind of fly under the radar of the securities laws, but still kosher, just don't pay interest on it. But it's a great way to get going with the community investing. Something called Community Source Capital is another platform. I'm just giving you kind of a little broad view of the platforms that exist right now. A bunch of them will start coming out once the SEC finally writes the rules for the Title III of the Jobs Act that we've been waiting for. But for the time being, these are platforms that can still operate within the current law. And there's another one that I find very interesting. It's called Fundrise. And they basically offer the ability of the community to participate in the development of commercial real estate in their neighborhood. And they are taking the Reg A route for registering the securities for the geeks among you. So anyhow, this is what I have. And as I said, this is an amazing moment, because 50 years from now or 100 years from now, people will look back and say, either they're not going to be around, or if they're around, to say, wow, those guys finally understood the importance of aligning the investments with their values, with their empathy and compassion, and with their desire to bring about a world where we can live well. So, thank you very much. And
in the Bay Area for well over a decade now. And I would say to anyone who's considering a DPO, that's really the #1 ingredient that I think you need to have, is a really strong base of support and visibility already, so that you're not spending a lot of time and money just trying to be visible to the public. Really what you need to be spending your time on is getting that public to make an investment, not just getting them to know who you are. And so that seemed like a good fit. And then secondly, we really felt that it was the right time.
The question is, am I ready to raise money, period? I mean, that to me is the biggest question. Do I need to raise money? A lot of people recommend, if there's any possible way you can go forward with your business and do what you want to do in your business without raising money from investors, that's the best. That's awesome if you could do that. However, that's not always possible. So the minute you know, I need to raise money to get to the next step, then the question is, how am I going to do that? And then I think for a lot of small mission-driven businesses, a DPO is a really good choice. You know, you don't want to waste a lot of time going after investors that maybe aren't going to be interested because they're looking for things that aren't in line with what you're planning to do. Or maybe they are interested, but you're not really happy about what you have to give up to bring on those kinds of investors. So, you know, I think the big hurdle is, do I need to raise money? If so, know all your options, understand the pros and cons of all the different ways of raising money. There's no perfect way to raise money. They're all, you know, time-consuming, cost money, not always fun, but know what the pros and cons are. And yes, we are doing a boot camp. Thanks for giving me a chance to mention this. So on Monday, we're launching a direct public offering boot camp. It's really not for businesses that are undecided if they want to do a DPO. It's for businesses that know they're ready to move forward with a DPO.
I think that perhaps just as you did this wonderful transition from the, I guess the securities trade industry and into this wonderful, wonderful thing, I think that you have the brilliance to actually make the arguments for the arts. And this is because I have here handy dandy, and I'm an artist, and I want my business to be about the arts, and I want it to be about investment in the community. There's this whole new economy called the creative, the creative economy, which is about, place-based creative placemaking and what happens in the community. And it is based on the work that artists do. But just so that you know, this is a study from the Otis College, commissioned by the California Arts Council. $2 trillion in California economy, 7.8% is in the creative industries, which have their foundations in the arts. Total impact is $273.5 billion. Tax revenues is 5%. So, and this is just, like in the LA Orange County district. So there must be a way. I don't have your brain, but I'm just throwing down the gauntlet because I really believe that just as we have to reconsider how we use, I think the only thing that there isn't, I took a microeconomics class. That was my first, I started an MBA and quit because of my microeconomics class, which is this philosophy of, insufficiency and shortage. I come from the third world. And the arts are what keep people going. You find some rubbish and you make something on it. That's what my business is going to be based on. I mean, it's like the rubbish people throw away is not rubbish. You just have to, the arts teach us how to reimagine, reinvent, recycle. So Marco, please figure out how investors can use the arts.
So let's just make that a yes or no question. Yes, Marco, yes or no?
Let's connect. disconnect. I mean, I would love to see it. Basically what I was going after is that there needs to be a whole non-financial component and understanding about the importance of the arts, which is what mobilizes the community's investment. Then, if you're narrowing down, art to a way of making money and a way of generating return, you're kind of killing the goose that lays the golden egg. But that does not mean that there are not ways in which art can be profitable and can be, self-supporting. The proof of that is RSF Social Investment Fund is investing in some arts enterprises. So you see what I mean? Let's definitely talk.
You guys should, the Hack the Economy session in the afternoon, you guys should get together.
And I just want to say, let's not forget there are currencies out there other than the dollar. And those currencies might be also something to think about for things that are hard to make money on in the dollar economy. There's Baybucks, there's alternative currencies. A lot of us in the room are looking at how to make those a more viable thing too.
All right, let's give a hand to these guys.
Yet. I mean, they think you have a well-diversified portfolio in stocks and bonds around the world, you're going to be safe in 30 years for your retirement. I'm saying, no, not really. And that's the one thing that people have not quite grasped. On the other hand, I was a fiduciary, right? I had the fiduciary responsibility for the client's money. And so we are actually locked into, as fiduciary, this idea of diversification and investing in funds in all these mega corporations around the world. But what we're saying is that a lot of that activity is predicated on extracting the natural capital that is supporting our long-term survival. So at a certain point, we have to wake up. And so how do I merge that is really tough because, sometimes after I talk, people come to me and say, can you manage my money? And I say, I can't. I can't because I cannot guarantee diversification and I cannot guarantee that you are going to have a specific return. But actually, I would say not even the financial advisors can do that.
You know, it's like if you look at the Japanese stock market, you know, it hasn't recovered in 20 years. And, you know, it's very possible that as, you know, the environmental crisis will increase, that some of the capitalization values will be lost. And so even a very diversified portfolio is not going to save us for our retirement. But at the end of the day, you see, that's the other thing that we need to keep in mind. And there's a bigger picture. By the way, Northern California Community Loan Fund is another of those great companies where you can invest even if you're a non-accredited investor, get a return out of it, and doing good things with it. So if you're sick, it costs a fortune to get better or go through the healthcare system. The food that is not poisoned or, you know, in the shelves for months, or that is, you know, organic, costs twice as much. In other words, our investments are then increasing the cost of our retirement. And so we need really to pay attention to both. And that some of the money needs to be invested in the things that will create the type of world we want to live in. And there's a big conversation. I mean, it's like the dogma of the past are no longer suited for the stormy present, as Lincoln said at a certain point. And we need to get out of the frame of mind of, you know, diversified portfolios, 6% for bonds, 8% for international stocks. You know, you dream that. I don't think that's going to happen in the next 30 years. There are going to be some major changes, and we need to start taking the money away. And yes, it's not going to be easy to do within the framework of the fiduciary responsibility of managing other people's money. That's why we need to start taking responsibility for our own money and make those decisions ourselves, right? Fiduciary cannot make values-based decisions for you and say, I'm going to take you out of, you know, the oil companies because I believe in renewable. They can't do that. You know, you can do it though as your own money. And unfortunately, I don't have an answer for you, but you understand the challenge.
So we have another little something that I want to bring in right now, and I'm going to introduce very quickly Kendra Shanley, who is producing a wonderful event that is going to happen partially here and other places on living the new economy. So she's going to tell you a little bit about it before we go to Jim.
Hi everybody, just a quick announcement. A lot of people that are here today, Marco's going to be back, Conda, Ed, Jenny, Bram, Arno, are going to be at another event in October that's here and down the street at California Endowment called Living the New Economy Convergence. And I have these green flyers that are also in the back, or you can come talk to me about it. There's a whole track on local money and finance. There's one on local food systems, local manufacturing, a lot of overlap of how those things interact. And it's actually 4 days long. Tickets are available now to come to all or part of that. Lots of discussion style stuff, as well as getting into project teams and starting to start to do some of this stuff on the ground here in Oakland. So we hope you'll join us. Come talk to me if you have any questions. Thanks.
It's going to be really amazing. We really enjoy Charlotte for this. I think you're going to love it. The team's doing an amazing job putting this conference together. So now we have one of our superstars in Oakland. We have a lot of superstars, so this is one of them. Miss Jenny Casson, who happens to be on the forefront of all of this information, all of this up for us, and she's just amazing. So let's give it up for Jenny Casson.
Thank you so much. Really, really exciting. I loved Marco's talk. I think it was the perfect way to set the agenda. and I didn't know exactly what he was going to be talking about, so there will actually be a little bit of overlap, but that's good. You know, I think one of the main points of what we want people to get today is whether you're an investor or an entrepreneur. And when I say entrepreneur, I am including a very broad range of entrepreneurs. You could be a nonprofit that is going to be, you know, has some way of generating revenue. You could be raising capital from your community. So when I say entrepreneur, I'm speaking very broadly. So anyway, we want to really make sure we address the questions that people have, whether they're an entrepreneur, an investor, or both. And so we want to really try to put ourselves in both shoes and make sure we're answering all those questions. I think Marco was talking a little bit more from the perspective of an investor and what an investor could do. And I kind of come more from the perspective of what entrepreneurs can do to raise capital. And I think that question about the cost of capital was a really important one. I'm glad you asked it, because one thing we have noticed is that when entrepreneurs raise money from their communities, the cost of capital does tend to be a lot lower. And I think there's a few reasons for that. One is it's a numbers game. If you can go out to everybody in your community, you just have more potential, demand for the investment. So you're not going after a tiny number of people who kind of hold all the cards. Also, I think regular folks who are not professional investors have maybe a more realistic idea of what is a reasonable return. They're used to getting very low returns in a lot of their investments, so when you tell them you're going to get 5%, oftentimes they're really happy about that. Let's see, what else did I, also, people can diversify their investments. Usually with community investing, the minimum amount is quite low, so you may be willing to make a riskier investment with not a super high return because you don't have to put your whole life savings in. The minimum investment could be fairly low. So it's a great point. I'm glad you brought it up. So I'm just going to quickly go over Securities Law 101. I think I just used up too much time on that little aside, but I'm going to try to speed it up. And in your handout, I provided the handout basically kind of summarizes what I'm going to be talking about. So, let's see. So does anyone know what a security is? Basically, it's any kind of investment where you can make any kind of a return on your investment. So it's going to be pretty broadly defined, and the general rule is if you're offering a security, you do have to register it at both the state and federal level with the securities regulators. So you have to register it. Registration means getting approval and providing a disclosure. It can be a pretty onerous process if you have to go through the whole registration process, especially at the federal level with the Securities and Exchange Commission. Of course, there are some exceptions to that rule. Obviously, everything that happens, like in a Silicon Valley type of investment with a venture capitalist investing in a business, that business isn't going to go ahead and do a full federal requirement. But there are actually legal ways for non-wealthy people to invest in their own community. And there's so many different ways to break down all the categories of community investing. So we thought it through and we came up with 4 categories, but it could be broken down in lots of different ways. And we're going to be having 2 panels, the first panel in the first 2 categories and the second panel in the second 2 categories. We're only going to have one example of each of the 4 things. But I'm going to talk about a couple of other examples. There's also some examples listed in your handout. And I'm going to be sitting on both panels, not talking, but just available to answer any legal questions that come up. So the first one is private offerings. And this is where, so when you raise money from accredited investors, you're usually doing it in a private offering. And not that many people know that there are actually ways to include unaccredited investors in private offerings as well. Usually there is a cap on the number of unaccredited investors in a private offering. But in a private offering, you're not announcing it to the world, you're having one-on-one conversations with potential investors. Each state's laws governing private offerings are a little bit different. In California, you can have up to 35 unaccredited investors, and they do have to meet certain requirements. Basically, you have to have a substantial pre-existing relationship with them, or they have to have an advisor. But every state's different. But these are some examples of private offerings. So Awaken Cafe down the street did a private offering to raise money for their cafe, and they did it one-on-one, talking to people they knew, and they did include some unaccredited investors. And then we have investment clubs and investment networks. So those are really just a way to facilitate private offerings. So Solutions is one that I worked with in Alabama. It's an investment club that's going to be focusing on investments in Alabama and Mississippi. So it's a bunch of regular folks getting together, pooling their money. and they're going to be pooling it into an LLC and investing in some businesses. Slow Money, as Marco talked about, is an organization that facilitates investors and investees kind of getting together so that they can make investments in each other. The second category is direct public offerings, which happens to be one of my favorites. We do a lot of work with direct public offerings. Ben & Jerry's did a direct public offering when they were first starting out, raising money from residents of Vermont. The minimum investment was like $120. I think 1% of all the residents in Vermont became shareholders in Ben & Jerry's. So a DPO is, it's a type of investment offering where you've gone through some of the hoops that actually makes it possible to do a public offering and accept an unlimited number of unaccredited investors, so you don't have that cap like you do with the private offering. And surprisingly, a lot of people don't know that it's legal now. When people talk about the Jobs Act and the new crowdfunding laws, you'll hear them say, oh, you know, finally it will be legal for regular people to invest in securities or equity of businesses they want to invest in. Well, guess what? It's actually been legal for years. Ben & Jerry's did it. We've been doing it with our clients. So please spread the word. It is legal now. I'm going to whiz through these, but these are some examples of our clients that have done these. Farm Fresh to You did offered a note, and the interest on the note is payable in product, so they're organic produce rather than cash. Quimper Mercantile is one of our clients in Washington State. They used it to raise money for a startup retail business. They sold common stock to their community and had over 1,000 investors. Real Pickles is a client of ours in Massachusetts that sold non-voting preferred stock to their community in Vermont and Massachusetts. So the Crowdfund Act, you know, some people are excited about it going into effect. I'm not that excited, to be honest with you, because if you actually read the law, it has a lot of things in it that are going to be difficult for people to comply with. So I'm not that hopeful that it will actually add that much in terms of, you know, options for people to raise money. But, you know, hopefully it will be something that some people will be able to use. We actually have a handout at our table that compares some of the different provisions of the Jobs Act with what you can do with different ways of raising capital. And this is the chart we have. But interestingly, you know, as Marco said, a lot of states are now passing crowdfunding laws, and we have a list of all of them and what the provisions are, and it's amazing how many are either passed or almost, you know, being adopted, and those actually are going to be much easier to use, generally speaking, than the federal ones. So that's going to be really interesting. This is an example of a company in Georgia that raised money using the state crowdfunding exemption. And then, so that was all DPOs. And I do include the Jobs Act under DPOs because I think of the Jobs Act as just one more legal tool that allows you to raise money from the public, from both wealthy and non-wealthy investors. Okay, so the third category is platforms. Marco also talked about that. There's lots of different ways that these are legally compliant. Some of them try to avoid securities law coverage altogether by saying that what they're offering is not a security at all. I should have included community-supported capital, but I forgot. But these are some really great platforms. Ours, Cutting Edge X, is one that is just a listing of direct public offerings. So we're not actually accepting investments on our platform, but it's a place to go to find direct public offerings that are open. And then the fourth category is community investment funds. So RSF Social Finance is a great example of that. Northern California Community Loan Fund, you'll see. I actually was surprised to see that all of these are individual investors into their loan fund. So most of their investment comes from individual investors. So it's another place to think about putting your money. And what these funds do, they do their own DPOs, but they're raising money for the purpose of investing into other businesses that they want to support. So RSF is another one. We actually have a few clients that are working on creating these. One in Western Mass called Pioneer Valley Grows. one here called Bay Area Food and Farming Fund, which is at a very early stage. Mendocino Economic Development and Financing Corp., which already exists, and we're helping them do the legal work to make it possible to raise money from their community. Food Commons is another organization that's probably going to be doing these. And then I just wanted to mention, someone brought up the question of like, what about, you know, the tax issues and the retirement issues? So I just want you to know that it is possible to take the money that's already in your retirement account, and instead of withdrawing it from your retirement account, which can have a negative tax effect, you can actually just put the money into a custodial account and direct the custodian to invest it in whatever you want. So you can still keep all those same benefits of your retirement funds, but direct them wherever you want to. Thank you.
The IRA, very few people have actually done it. So I have done it. If you want to, reach out to me. We as Slow Money Group have done a little bit of due diligence on the various custodians. So we have a list of custodians and our experience with them, what we found out in terms of fees and service and so on. So we can definitely share that with you if you're interested.
I'd love to hear you riff a little bit on your thoughts around the divest and reinvest movement. See if you have any insights that apply here, any points of influence for larger investors, mutual funds, universities, etc.
So divest, reinvest, I don't have a lot of expertise on talking about how this can all be scaled. I wish I did, and probably Marco might more than I do, but what I really focus on is investment opportunities that are maybe in the range of $500,000 to $2 million. That's what our clients are usually raising, and with a minimum investment of $1,000. So what I really focus on is things that are open to small investors. I haven't given a lot of thought to how a large institutional investor like a university could get into this, but Marco probably has.
Yeah, there's actually a website of foundations that are committed to divesting from fossil fuels and moving their money into renewable energy. And those institutions will probably have to do a lot through direct investing. So, go from a publicly traded company that is very easy to access, or a fund, to direct investing. And some foundations might have, the bandwidth to engage in that. And others will have to rely on probably pool funds. And there are some things that, the Mosaic, we didn't talk about Solar Mosaic, but that is another platform that might be institutional quality aggregators of funds, but I'm not familiar with that. But we have to start doing this work, and at the beginning it's going to be hard, but we are charting the path.
Thanks, Marco.
The interesting thing is that the foundation money is set up to do good, and so why would we not use it to do good, right? Because it's invested in things that could be completely contrary to the mission of the foundation. That is something that needs to be addressed.
So, hi everyone again, I'm Erin Kilmer-Neal. We're going to do the first of our 2 panels for the day, and then we're going to take a break and have some time for you guys to all get to know each other and see who's in the room. So this panel is focused on the 2 first kinds of investments that Jenny talked about, and both of these are around directly investing in specific businesses. So on stage we have Marco Evangelisti, as you already know, who's going to talk about slow money. We have Bram Amani, raise your hand and say hi, Bram, founder of People's Community Market, who's done a DPO for his funding for his market. And Jenny, as she said, is going to stay up here and be the lawyer in the room answering questions as needed. I wanted to do just a quick question by raise of hands of the 3 different types of people who might be here in the room, and you might be more than one. The first is, are you an entrepreneur raising money, hoping to raise money for an endeavor? Raise high. All right, quite a few people. Are you a regular community member hoping to invest your money locally? And you could be multiple categories. All right, that should be everybody. And then the last one is: are you a community activist, rabble-rouser, wanting to change the system and figure out how we can make these models work and spread? All right. So that just gives these guys an idea of the kinds of people in the room, so they can answer questions about the models that they've been experiencing and raising money with. And I think that's it. So what we're going to do is we're going to do 10 minutes for each of the two panelists, 5 minutes Q&A afterwards for each panelist, and then a nice chunk of Q&A at the end to cover the whole panel. So I'm going to go ahead and start off with Bram. And Bram, I think you have a mic, which may not be on yet.
There we go. Hello? Yeah. All right. So, hey everybody, I'm Bram Malati, People's Community Market. I was asked to basically come here and just tell my story as an entrepreneur, raising community capital, why we did that, how it went, what the result was, why it's been great for us. First of all, you can check out the business. I won't get into too much detail, peoplescommunitymarket.com. It's a new business, pre-operating business. Will be a full-service fresh food grocery store in West Oakland, 15 to 20,000 square feet in size. Our focus is not only to increase access to fresh and affordable foods, but to also act as a community center and resource in the neighborhood. Very similar, actually, to the Impact Hub as a convening place in the neighborhood. So in addition to a retail store of 12 to 15,000 square feet, an additional space of some number of thousand square feet that is essentially a community space in West Oakland for events, for educational programming, workshops, as well as recreation and socializing, and really being inspired by the opportunity, being a neighborhood grocery store, being an anchor to that neighborhood, of being a place for convening across the diversity of the neighborhood, and really feeling that in a time of gentrification in West Oakland, that's even more important now, to be bringing these different sort of pockets of the community together, to build community together. In 2011, the second half of 2011, I went on the pitch circuit with a private placement to try to raise capital for our startup business, and went into that having heard a lot of great feedback from program officers at foundations and PRIs at foundations, from the sort of preeminent social impact groups and communities around the country, and a lot of sort of progressively minded or oriented accredited investors, individual investors, that there was interest in this issue. Over 400 communities in the United States that do not have access to foods in their neighborhood, representing significant economic opportunity, but also very significant public health issues as well in terms of the problem. And so we sort of heard the feedback that there was likely an opportunity there to raise some capital through a private placement. So, did that and really grinded on that for 6 months in 2011. And went to all the sort of typical go-to places around the country and did a pitch, and had a pretty good pitch, won some pitch competitions even in that process, and found out, by the end of that year, not surprisingly now, looking back on it and everything that Marco and Jenny have already said today, that it was completely not a fit for us as a business, nor for them as private investors. I think 4 really big reasons. At that time, 2011, still in the recession, a lot of investors saying, we're just not doing startup or even really early stage if we can avoid it. And it's got to be really hot and really compelling, which means pretty much sort of, especially in the food space, a much more premium-oriented product or brand. And as an example to that, I did pitch in one, and I'm sharing this for the entrepreneurs that really understand that there are some downsides for the private placement approach, depending on who you're going after. But I did a pitch with 5 other food entrepreneurs. We were in the food track at an angel investment group in Philadelphia. And of those 5 food businesses, all which were outstanding, and we were in fact the only startup in that group of 5, only one of the 5 ended up getting any investment at all, and that's because it had not only been established for a very long time, basically a pizzeria in Boston, it had just landed a really big contract with Whole Foods to carry a high-end artisanal fresh pizza product, packaged refrigerated pizza product. So it's kind of a slam dunk for investors. The other 4 of us, food entrepreneurs, didn't get a single penny there. So it's kind of emblematic of some of the challenges. So issue number 1 being a startup. Issue number 2, the rate of return, as Marco touched on in his presentation. Most private investors telling us we need at least an 8% return on this, which was well beyond our capacity as a low margin food business committed to affordable pricing and fair wages to our employees, and really beyond what we wanted to do in terms of really maximizing our mission, and making our mission the sort of central component of our business decisions. We felt that if we were feeling pressures to pay higher returns, we would have to make decisions that would be less optimal for our mission or even be at odds with our mission, and we didn't want to get into that. Thirdly, wanting to see a form of exit or liquidity that precipitated a more significant upside for them and also followed a more traditional path, essentially of a merger or a sale of the business. We're really focused on local ownership, being a local business in Oakland, so that wasn't a fit for us. We didn't see that both from a values perspective, but also we just didn't really even see the likelihood of any significant sale of our business in the future with our focus on an underserved market and community. And then fourthly, wanting to see rapid growth and scale to the business. Being told literally, if you go back and rewrite your business plan, open up 10 of these stores in 5 years, I'll take a more serious look at your business plan and your opportunity. So obviously none of that was a fit for us. Came back to California, pretty bummed out, went and talked to Jenny, and she proposed the idea of the DPO. I think for a few reasons. One, People's Student Market comes out of many years of work with our nonprofit People's Grocery. So we've essentially created a sort of fan base and a large support network and visibility in the Bay Area for well over a decade now. And I would say to anyone who's considering a DPO, that's really the number 1 ingredient that I think you need to have. Is a really strong base of support and visibility already, so that you're not spending a lot of time and money just trying to be visible to the public. Really what you need to be spending your time on is getting that public to make an investment, not just getting them to know who you are. And so that seemed like a good fit. And then secondly, we really felt that it was the right time, that there were a lot of individuals who were in 2011 with the recession, several years of the recession, frustrated with the large global financial system, wanted to do the recommendations that Marco made, which is to move their money and do more local investing and local shopping, and so we felt there was a good opportunity. We were particularly attracted in the DPO as an investment structure as opposed to a donation-based crowdfunding platform. We felt that there was an opportunity to create a sustainable transaction with our investors. So rather than asking them for essentially a donation that they'll never get back or see any benefit from, we really wanted to make this an investment deal. We needed it to be low cost for us, and we needed it to be very patient capital. But at the end of the day, we felt that that was more aligned with our principles to do it as an investment that we could repay. And then secondly, we wanted to, in fact, prove that in our business case and in our market opportunity, there is a sustainable transaction that can be made. And then thirdly, we also thought that that would really stand out differently from what at that time and kind of still now were these sort of oversaturated donation-based crowdfunding platforms and sort of spaces. A lot of noise, a lot of competition in those spaces, very few real investment opportunities for people like us. And so we felt that if we made it a real investment opportunity, it would actually sound really different and be more appealing to either those same individuals who are donating or to new individuals who were not attracted to crowdfunding. So you can visit our website, peoplescommunitymarket.com, and learn all the details of the terms and how that was structured. Very low cost of capital for us, 3%, and patient capital. Our repayment terms are redemption at the end of the 7th year of business operating history. So we have quite a while to pay the money back and a low cost of capital, which again really maximizes our mission focus in that deal. In terms of how it went, we did reach our goal, which was $1.2 million. Our goal was to raise that by the end of 2013, which we did. We launched our campaign in November of 2012 and ran it really intensely for those 14 months. to get to that goal. And it was really, frankly, the last 3 months, I think, that we raised the vast majority of it. So by September of 2013, just 4 months away from our internal goal for closing, we'd only raised about $600,000 of that money, so we really had to put the pedal down and push hard for the last 4 months. And I can get a lot of details later if people are interested in terms of how we got visibility, how we did the marketing and all of that. But we were ultimately successful. 400 shareholders, as we prefer to call them, founding shareholders. 85% are unaccredited investors. 50% of them investing at our minimum level, which was $1,000. So they represented about $200,000 of the 1.2. So although that was not a significant chunk of cash, it was the significant base that we had built through it. And also very local, so about 55% Oakland residents, another 25% or so East Bay residents, 95% Bay Area. So this was a super local and super small investor focused campaign. That's how we designed it from the beginning, and it worked perfectly based on those principles for us. And so I think the biggest takeaway that I would, or lesson I would say for everyone, as I stated earlier, is if you're thinking about DPO, don't worry too much about how you're going to generate visibility. Make that assessment whether or not you have it, and focus a lot more on the closing process. We found that the majority of our investors took 4 to 9 months to actually make their investment. So it's a very long tail on the process, especially for unaccredited investors who've never done this before. So for them, it's a psychological process. They're kind of intimidated. They're overwhelmed by the offering memorandum and all the legal speak and the idea of actually making an investment. Well, I should really look at the paperwork, right, before I make this decision. Yes, you should. And obviously for a lot of people, it's a psychological barrier and just a procrastination factor, right? Or folks are just busy and it's not on the top of their to-do list. So that's kind of the main thing we found. It wasn't hard for us to get a lot of visibility. We're already fairly known. We got good media hits on this. The challenge was getting people to actually complete the process. And I have some tips on how you can help do that. So.
Thank you, Promise. That was great. Questions? Oh, questions? I'm going to run around and give you guys the mic, actually.
All right, just curious how much you think it cost you to raise the 1.2?
So we thought about that a lot before we launched our campaign. We read stuff. There was a book by another attorney named Drew Field on DPOs, and he made a recommendation to cap your spend at 15% of your total raise, whatever your total raise is. We capped it at 10%, and we kept it at that. So we spent essentially $120,000 to raise the $1.2 million. We spent the majority of that in those last few months to make that final push. So we did not purchase any kind of advertising until we went into the fall. And then we felt like it was time to really put the foot on the pedal and push hard, and we did spend some money on that. The rest of our costs were legal and administrative, just sort of basic monthly overhead.
And we were able to...
Sorry, other questions? We might get it back.
Can you say a little more about how you got recognition in your marketing?
In our marketing. Sure. So, as I said, for me, the key principle and decision point for us in deciding to do DPO was the assessment of whether or not we were already well positioned to have that visibility. Because at the end of the day, we did not want to exceed 10% of our raise and expenditure, so we didn't want to have to spend a lot on marketing to get visibility. And frankly, if we could spend less than that, great. And so for us, the focus was really, first of all, framing this sort of on Marco's investment compass idea. For us, it was aligning with investors who were going to be primarily attracted on vision, mission, and impact and values of our business, not on the financial terms. So we were very careful to screen our offering on those strengths as opposed to the financials. And then to initially focus on our existing networks of support. So we had a database of 20,000 relationships or contacts that we built over about 15 years. And we went to them first. The pre-existing donor networks we cultivated through the nonprofit and just general support. So as I said, we didn't really do any significant marketing until September of 2012, which is almost a year after we launched our campaign. So the first 8 months, 9 months were totally grassroots, relationship focused. on the ground. We did a lot of house parties, so people who would make an investment would host a party at their home for 10 or 20 people and grow the network that way. And I'd come, or some of my team members would come and do our talk and meet people and whatnot. The relationship piece we felt was really key for people to both have trust in us and confidence in what we were doing, but also to really, again, psychologically work through the idea of the investment, ask the questions they needed to ask in order to feel comfortable with the idea of doing one. When we got into the more traditional sort of marketing efforts, which again were basically the last third or almost last quarter of our campaign, we placed ads in some local publications, East Bay Express, Oakland Grown, a few other groups like that. We had a couple poster campaigns at key BART stations here in the East Bay. And the biggest one, most important for us, was free media coverage. So we did spend money to hire a PR firm, and they were fantastic, and they got us great media, New York Times, San Francisco Chronicle, and others that generated a lot of visibility. And we saw a very direct correlation between the spikes in our fundraising campaign and those media exposures. They were always very consistent. Whenever we would get a notable piece of coverage, we saw significant investment activity, both from our sort of existing base of leads that we were already working on, but a lot of new people who were also hearing about us because of the article they read in the newspaper or whatever. So the more free you can get, of course, the better. For us, the strategy was to basically exhaust all of our free grassroots sort of guerrilla marketing efforts as much as possible. Then go into PR, using free PR as much as possible, and then spend money at the very end if necessary, if we're still too far away to do it on the free marketing efforts.
All right, thanks, Bram.
Yeah.
So we'll have minutes again at the end of this panel for more time for questions for Bram. We're going to move on to Marco. Marco, as you've already met, is going to now switch hats and talk specifically about the Slow Money Network here in Northern California. It's also talking about investing directly in specific businesses, but in this format, a investing network. So how does Slow Money work as a network to loan to direct businesses? Marco, take it away.
Yeah, so as I mentioned, I've been involved in Slow Money for the last 4 years. We have a very active chapter here actually we call it Network now. And if we see the chart, I don't know what we need to do to show something. It will come up soon. Yeah, so this is a chart. I don't know if it is visible from where you are. It's not visible from where I am. Now it is. It's a little bit the process of how do we, as a network, reach out, find investments, and then invest in enterprises. So there's a wider Slow Money community on the left. There's a little bit of a very lightly colored thing that is going on and off. So maybe we'll make a copy of this and make it available for you. But basically, there are two ways in which we learn about entrepreneurs. And one is through our website. We have a website, and there's a tab for investors, and they can just register their project, and we find out that way. Or through personal contacts. People show up at our meetings. So what we have is we have regular monthly meetings, and usually we have there on occasion for entrepreneurs to introduce themselves, to get in contact with us and the people attending. But we also have short presentations that we call spotlights, where we feature a couple of entrepreneurs that talk about their business for a couple of minutes. And the whole thing about Slow Money is really about establishing those personal relationships with the entrepreneurs. And we do that for a couple of reasons. One, because we think that the relationships are more important than the transaction. And the other one is for to comply with the law, if you want, in private offering, the fact that we have meaningful prior connections and knowledge of the entrepreneur allows us to do it under the family and friends exemption, if you want, from registration, which is a 2510-2F. I'm getting that right. So, in any case, that's basically the first step is how we learn about the entrepreneurs connect with the community. And then we have various ways in which
which investments can take place. So we have obviously some accredited investors, so wealthy individuals that might learn from our meetings and our showcases and our Farm Fest. We also have an event a couple times a year where we do a bigger show of entrepreneurs. And so they might, connect directly and make transactions. So some large transactions have occurred in Northern California directly. Sometimes we learn about it, sometimes we don't, but these are people with means that come to our meetings and then connect with the entrepreneur directly. We also have, of course, some other platforms like RSF, Ag Funders, and so on, where some people get to. I don't know what's happening with this thing, but this is basically our website, and there is an area called Showcase, where you can see the various enterprises that have presented at Slow Money, and the venues and ways to invest in them. So we also have a group called the Soil Network, Slow Opportunities for Investing Locally, and these are both accredited and non-accredited investors that are part of this group. Is almost like a support group for investors, where the people that have an interest in investing in one of the entrepreneurs invite the entrepreneurs over to present to the whole group. And then if there is an interest from more than one investor, they can team up and kind of do a tag team for the research. So they go and visit the entrepreneur, they look at the books, they do the, I don't want to call it due diligence, but kind of a little bit of that. So do a little bit of research to find out if the investment is worth making. And then we have some crowdfunding platforms like Indiegogo, Credibles, and Kivasit, and some of the entrepreneurs end up listing in those platforms. And so if you go to, since I cannot show it to you, you go to slowmoneynocal.org, and then there is a tab called Showcase, and you see the various enterprises that have presented and contacted us, and ways in which you can actually invest in them, whether that is through the Credible platform, through Kivasit, through AgFunder, or if they're in the Soul Network, you can join the Soul group and then take a closer look at that. We've done probably about 15 transactions so far, ranging from equity deals, although those are few and far between, some loans with royalty kickers, some royalty structures, in other words, just repaying of a percentage of the revenues of the business. So this is all in progress. It's a lot of fun, and actually seeing an enterprise that you've invested in thrive provides this psychological juju that you cannot get from a statement from your broker. It just does something special to see. In fact, the day I'll walk into Bronx People's Community Market and get my sandwich there, it will be a really thrilling day. So there is something about real investments in your communities that you actually can see, touch, smell, and eat. So that's that. Any questions?
First, a hand for Marco. Thank you. Questions? Yeah. I'm going to ask someone to help me out.
Maybe a CDC person help out?
That's okay, at least I can help. Questions? Your first question, guys.
So this is for Marco. In your first segment of your presentation, you looked at the conventional tools for assessing an investment. And now with the open mind that we're progressing towards, how does an enterprise, maybe a couple of tips on how you can showcase the other kind of benefits that you're providing that are not necessarily limiting risk, maximizing return, but that are the community values that you're providing as a business. And I'll specifically state my case. I started a farm-to-table restaurant 2 years ago. Some of the value benefits that I think I provide is I've created 20 full-time job equivalents in a rural coastal area. I'm supporting 3 full-time fishermen, 3 organic farms that are very small and have each a couple of employees. And we do community give back. So in the last 2 years, we've donated back in terms of monies, almost $40,000 to local nonprofits. So if you look at my business, I'm still just about break even. So from a traditional financial model, people look and go, well, wow, there's no great return here. We're looking better financially, but still, our community benefits, I think, are significant. And I'm considering going towards a DPO and wanted to see what you can maybe suggest on how you can leverage or like showcase your community things.
Right, that's a great question, and that's the key of relationship investing and community investing, right? If I look at my portfolio now, it's not liquid at all. I liquidated my portfolio in 30 minutes. And now most of my investments, Bram probably going to be 10 years, or no, let's say 8 years before I see the money back. So there's no liquidity there. A lot of the investments into loans are for 5, 6, 7, 8 years. So that's the first thing we have to come to term, that we are really invested. I mean, can you really call yourself invested if you can get out of it in 5 seconds, right? So the idea of investing is basically give up liquidity. So you need to know, this capital is tied up for a long time. The return, a lot of the return, obviously would be ideal to get the capital back and a little bit of return. And it will happen in most of the enterprises we've invested, but not all of them, right? But the component that you have to stress is what is the non-financial return. Because at the end of the day, we want to have a community that has jobs, we want to have access to good food, we want to have places where we can congregate and we can meet each other and talk to each other, like the Chatham Market, right? Or the People's Community Market. So you have to speak to, and I guarantee you, if you make the argument, invest in me because of the return, that's not the way to go. You have to be clear about the fact that, your plan is to return the capital and return a little bit of return. But that's really not the focus. The focus is what are the other benefits that your business is creating for the community. And all the things you've mentioned are great things to highlight. And that's the reason why people are investing in it. Because at the end of the day, we need money to do what? To live a good life. And so if your enterprise is creating the good life we're after, that's it. That's the return. It comes in that form, right? I mean, it's like we better, let's imagine we get less return, but we're more healthy so that we don't have to spend a fortune to, cure our sickness. It's the same thing. I mean, it's like just paying attention to the return and then, I have to spend so much money down the line to, mitigate for the risk effects, health effects or whatever of our investments is really not the way to go. So kudos to you for what you're trying to do, and kudos for highlighting those community benefits. And that's what really would motivate investments on the part of the community.
I just wanted to say, I totally agree with that, but at the same time, I don't want us to undervalue a return of 2, 3, 4%. If you look at what alternatives are out there for regular investors, there's the stock market, which I totally agree with Marco. It might be making decent returns right now. Over history, it's only made maybe 2 to 3% on average, and we don't know what's going to happen in the future. You could put your money in an FDIC insured account and make very, very low return. So don't be ashamed, be proud to pay, a 2, 3, 4% return. That's a good return.
This is for Bram. I remember running into the People's Grocery people at the Green Festival, and there was talk of having a truck, a grocery truck at the time, and food stamps had gone from stamps to the EBT swipe machine thing. And I'm wondering, one, were any of the foundations or investor groups, whether that's nonprofit foundation or investors, talking about return in terms of the community the people access to produce. I'm wondering also, are you going to be tracking the amount of food stamps or SNAP money that comes through people's market as an indicator of how much community benefit that the business is doing?
When we ran our mobile grocery truck 2002 to 2007, our funders were definitely looking at evaluation outcomes for that. So yeah, we tracked it really heavily in terms of distribution of food, number of people reached, the types of engagements we had. We were not able to correlate or follow all the way through to any significant statistical change, because that's a very long time to measure in terms of dietary change or BMI change or any other kind of health indicator. So we use more anecdotal. And in fact, those evaluations were what led us to shift away from the mobile grocery store. We felt that it was too small, it was not able to have impact at scale, and it was not really financially sustainable either. And in terms of this business, absolutely, we'll be measuring on a lot of different outcomes, including food stamps, and we have to report to the government anyway in terms of food stamp utilization and expenditure. But for us, being a triple bottom line business, measuring our impact on social and environmental outcomes will be key to, I think, defending and maintaining the centrality of our mission focus, so that we can really correlate that those investments are having big impact, and that therefore, that component should be maintained for the long term, as opposed to maybe making more financial considerations in the future. So definitely for me as a founder, making sure we structure our company, our bylaws in terms of any investments and financings we take to really enable the mission and the decisions around mission to be central will be important ongoingly, and being able obviously to have data and metrics that support those decisions will be key.
Good morning. My name is Linda, and I'll stand because I'm short. So I'm kind of going to come at this a different way, just listening to it because I really enjoy the conversation. I'm very interested in investing in the arts and making the arts, because I think, we're talking about food and sustainability and some, practical stuff, but I also happen to believe that investing in the arts is good for the community as well, and that there's a rate of return on that, but unfortunately it's all...
And there's a painting that is worth, they're trying to sell for $300, and they'll say, would you take $100 for it? In other words, there is this they wouldn't, negotiate with the dentist and say, oh, that root canal, how about I'll pay you, $1,000 for it. But the reason why we feel free to do that as a society is because art functions better in a gift exchange economy. You as an artist has a gift, right? And so you're kind of supposed to give it to the community. And that is how it's been done for years. And so attempting to put art within a commodity exchange economy is very, very difficult and hard from a cultural standpoint. That's why I still believe the community needs to support the art through their gifts, because arts are gifts. And if you're trying to commodify art and think in terms of rate of return on your investment, you're not going to go very far. And I speak to that because I've experienced it firsthand. And I think now, when I started saying, okay, all the art I have now is donated for benefits. So if you guys know about art benefits, I donate now all my paintings to that, and I raise money for other organizations. And that's basically the way I think it works the best. And so I would say, be very cautious about entering or trying to fit what works best in the gift exchange economy within a commodity exchange economy, economy and a marketplace.
I have a couple thoughts about that. One is I just invested in a dance company in San Francisco. I invested $25 indirectly on this platform called Collective Sun. And so they're going to be putting in solar panels, so I invested in the solar panels. So in a way, it's a little bit indirect, but they're going to be saving money by having these solar panels, which is going to free up more money for their programs. So that's kind of an indirect way you can invest in arts programs. Collective Sun, there are other platforms out there. There have been in the past that are similar. Also, what's the other? Oh, I know. I have a client that's a school, so it's not an arts program. It's a preschool. But it's a very affordable school. They have lots of scholarships. They do charge fees for some of the children, the wealthier children, subsidize the less wealthy children. And they do generate revenues, not a lot, but enough that they can actually borrow money and pay a return on an investment. So I think it is possible for an arts organization to generate enough of a return from, if you can generate any kind of revenue at all, which I know can be really difficult with an arts organization, but if you have classes or performances or anything, you may be able to generate enough of a return where you could actually bring in investment and pay some kind of a return on that.
Right, and I failed to mention almost my counterexample to what I just said, which is RSF Social Finance is investing and making loans to arts, food and farming, and environmental organizations. So there are, dance companies and symphonies and so on that need to borrow maybe to, build a space or to. So I mean, it's possible to invest in arts organizations. It's a little bit hard to do it on a very small scale, or if you're an individual artist. But so I would encourage you to look at the lending criteria of RSF Social Investment Fund, and they do make loans to art organizations.
Thank you all so much for your work. It's really valuable to hear from your experience. I have a particular question about the barriers experienced by low-level investors, and Bram, you were mentioning, it's actually a question for both of you, but there can sometimes be a several-month process that people go through when they're considering investing. So I'm interested in what barriers most often come up for people that you've been able to address and that you think are common but might be a misconception that they have. And then what barriers actually end up keeping people from investing, things that maybe we as a community want to work on addressing together so that there can be more investing.
I think for us, the main barrier, which I did touch on earlier, was supporting prospective investors actually follow through to make their investment. In fact, Mark and I talked quite a bit at a certain point during our campaign about really expanding our educational work with our prospective investors, really understanding that there was an education process that many who had never made an investment needed to go through first to feel informed and ultimately confident about the idea of making an investment, whether it was in us or any other direct investment opportunity, because the majority of unsophisticated and unaccredited investors have never done it, or maybe at best have done it through an intermediary. So they're relying on the expertise of that intermediary and the confidence they put into that intermediary to handle the decision making and the screening and the transaction for them. Obviously, this is very different. This is a direct investment. It's us as a company and you as an individual interested in doing that. So we did have to ramp up our educational work with those prospects, really understanding that that was probably the primary bottleneck for many, or at least a very large segment of our prospects. So we had weekly info sessions, we had extra documents and handouts, and for example, these house parties that I mentioned, spent a lot of time sort of walking people through the nitty-gritty details about this securities offering. What does it mean? What are their rights and responsibilities as investors, as well as ours as a company? So really, I think the educational process, if you're doing direct investment, is a big part of your job. You will find that a lot of people will be really attracted to what you're doing and excited, and then there'll sort of be this moment where they're like, I need a lot more information, and frankly, I need you to kind of walk me through the process. So a lot of people are not interested in spending their own time reading the 35-page offer memorandum. They wanted to come and sit down with me or someone on my team, or do it by phone and walk through it together, so they could ask all the questions they needed to and then feel really confident. I think a great solution would be to have a trusted local intermediary that does that walkthrough on behalf of DPO listings, and maybe that already exists.
So, Bram, I just wanted to follow up on that question. You did some creative things to help the West Oakland community participate in the investment as well. well, right? So you had a minimum investment of 1,000, but you did some things. Can you speak to that a little bit?
Yeah, sure. So we knew we had to set our minimum at $1,000. And the reason is that even though, as Jenny said earlier, you can have an unlimited number of unaccredited investors, there is a tip that happens at 500. When you are a state offering, as we are with this DPO in the state of California, once you reach 500 shareholders, you become federally regulated. And it kicks in a whole new level of regulatory requirements, compliance, and you have to have a significant amount of assets to have those numbers of shareholders as well. So we wanted to cap it at 500, and we just sort of did the math. What's the minimum we need to raise? And therefore, what is the minimum that we need to set this at? So we set it at $1,000. And knew that for a lot of people, lower income and working class families, that would shut them out. They would not be able to afford $1,000. In fact, a lot of middle class people can't necessarily do that either. So we tried different things. We partnered with Credibles on an offering, which we still have in place, and plan to drive harder as we get closer to opening once we have our site developed. We did a number of local opportunities with matches, where an investor put up some capital, essentially matching the investments from smaller investors coming into it, so we were able to really meet the minimums that way. We also use matches as a way to push the inertia on a lot of individual investors who I think were quite serious about investing but just hadn't gotten into it for whatever reason. So we partnered with a number of institutions. In fact, RSF did a $50,000 match, and a number of individuals in other cases. Kind of a play out of the nonprofit kind of fundraising world, where we said, you know, a certain amount of capital is up, and we can get that money matched if we raise an equivalent amount by a debt load. And that definitely helped push a lot of people who were planning to get around to it, felt the closing date was a long way away, really felt no urgency around it, so we were able to create sort of short-term senses of urgency to help. And we partnered with SBA on the local rewards card, as well as with Oaklandish on a t-shirt, customized limited edition t-shirt offering as non-cash match opportunities, and that helped a lot as well to incentivize people.
I just want to say one little thing, which is we also have to recognize how our brain works. And brain research has determined that our regret for action is greater than the regret of inaction. So, you know, if we sold a stock and then the stock goes up, we feel more pain than if we hang on to it and it drops in value by half. And so this explains a lot of the inertia. And especially in the field of investing where people don't feel like they know enough, the idea of them, you know, asking them to do something new and do an action that could turn out bad, you know, or there is risk associated with it, it's very hard. So just recognizing that, you know, we are wired to stick with the status quo and not taking risks. By the way, at the end of one's life, the thing will reverse. So at the end of the life, we regret the things we haven't done more than the things that we've done. So the regret of inaction become really big at the end of your life. So it's an interesting psychological thing.
Last question.
Hi, my name is Josephine Chen, and I act as a financial advisor and a startup consultant. How do entrepreneurs know when it's time to make that direct public offering? What ducks do they need to line up in order to do that?
I think for us, the biggest factor is we felt that there was no alternative way of doing it. We had just exhausted sort of every other option and path we could think of and tried first, pretty much all of those before we got to this place. So this decision point for us was largely around, do we go forward at all as a proposed project and venture through this DPO path, or do we just not pursue this and move on with our lives? That was obviously the most important decision point. I think the other one for us, as I've stated a couple times, is really assessing whether or not we were already well positioned in terms of our own visibility and a sort of primed network of supporters and fans that could be converted, the sort of low-hanging fruits, who were pretty much ready, just give me the word and I will invest, right? Like Marco. Marco was shareholder number one for us, literally like in the first day or two of our offering, he made an investment. I've known Marco for years. He was clearly ready and watching this. A lot of people were like that. So for me, that was the most important piece because it's the most cost-effective way to go about it.
Otherwise, you're just going to be spending a lot of time and a lot of money just trying to get people to know who you are before they even get to the specifics of the deal. Outside of that, I think having some marketing savvy is important. I and my team are pretty good at marketing. We like marketing as a sort of topic, an area of interest, and they're really excited by it. And I know, talking to Jenny, some of their clients don't have that strength necessarily, and so marketing has been a big challenge for them. And they're looking at outside help in that specific space of how do we actually market our DPO. So I think having in-house capacity and sort of natural marketing inclinations is definitely a plus. Those are the main two that I can think of. You know, there are administrative pieces that we had to build on the back end. There's now Cutting Edge X that can do a lot of that for you as a platform. Those are more detailed components, so I wouldn't say that they're key factors to have in place. Having good attorneys that can lead you through the process.
More specifically, the business model. How do you know that your business model is solid enough to go through the direct public offering process?
How do I know that my business is solid enough to go through a DPO or any other investment, right? As a startup and as an entrepreneur in a startup, you don't, right? You make your best, nor do your investors, and you obviously have to make those stipulations very transparently up front, that there is risk in this investment. So if you look at any of our investment-related documents, if you look at our website, you will find clauses pretty much everywhere. Some are state required and some are our own, provided to us by our attorneys, that are very clear about what the risks are. If you look at our offering memorandum, there's, I think, 3 full pages in the 35-page document that outline every possible risk scenario that could result in the failure of this venture. So at the end of the day, it's about, do you have a good plan, do you have a good team, do you have a good market opportunity, and do you have a good informed sense of being able to pull this off. That's the best you can do, and that's not unique to a DPO, that's in general with startup business.
And I would say Jenny should speak really quickly to your boot camp, because I think the DPO boot camp is a good way to answer that question a little bit, or at least explore the idea. And then we'll move on to our next section.
Yeah, so I mean, I guess the big question is, am I ready to raise money, period? I mean, that to me is the biggest question. Do I need to raise money? A lot of people recommend, if there's any possible way you can go forward with your business and do what you want to do in your business without raising money from investors, that's the best. That's awesome if you could do that. However, that's not always possible. So the minute you know, I need to raise money to get to the next step, then the question is, how am I going to do that? And then I think, for a lot of small mission-driven businesses, a DPO is a really good choice. You know, you don't want to waste a lot of time going after investors that maybe aren't going to be interested because they're looking for things that aren't in line with what you're planning to do. Or maybe they are interested, but you're not really happy about what you have to give up to bring on those kinds of investors. So, you know, I think the big hurdle is, do I need to raise money? If so, know all your options, understand the pros and cons of all the different ways of raising money. There's no perfect way to raise money. They're all, you know, time-consuming, cost money, not always fun, but know what the pros and cons are. And yes, we are doing a boot camp. Thanks for giving me a chance to mention this. So on Monday, we're launching a direct public offering boot camp. It's really not for businesses that are undecided if they want to do a DPO. It's for businesses that know they're ready to move forward with a DPO. You don't have to know all the details of how you want to move forward and what you want to offer, but it is for businesses or nonprofits that are ready to actually move forward and go through the process. So it's just a few more days left to sign up. So if you're at all interested, talk to me or one of my colleagues today or early next week. This week, I guess. It's starting next week.
All right, thank you. Oh, we have a burning question.
I think I'm going to explode if I don't. And I have to say, listen to anything since Marco responded to this question. And so I said,
Don is the president and CEO of RSS Social Finance. He's going to talk about the investment fund. And the investment fund is just another, rather than a direct investment in a business, it allows people to invest in a pool, and so of businesses that are mission aligned and values aligned. And so that's what RSF Social Finance does. And it's a wonderful, we're really fortunate to have him here in the Bay Area.
And so, Don, if you could just kind of give us an overview of how it works on both the business side, for the business, and then for the investor side, and kind of give us kind of a lowdown of how all that goes down. Okay, that'd be great. Thanks.
Hi, does this work?
It should, yeah.
Testing? Good. Hi, everybody. This is a really nice space to be in, given that there are no lights other than the sky. It's good to be here. I live about a mile up the road from here, so it's nice to have events in the East Bay where I don't have to leave my home turf. RSF is based in San Francisco, so I'm typically going over the bridge. And I first want to acknowledge that this amazing space, this amazing event, and I really want to thank Conda and Aaron for hosting it up for us, and all the other people that are working to make this happen. And I can't imagine a better legal advisory crew than the Cutting Edge team to be with. And I actually can't imagine a better macro investor perspective to have gotten from Marco, and an entrepreneur perspective to have gotten from Bram. So this is going along well, I would say. And so I hope that I could just shed a little bit of light on what we do at RSF. One part of what we do at RSF. We're a lot like a bank and a foundation combined, and I'm going to talk about the more bank-like part. But really, RSF started 30 years ago with a purpose statement to transform the way the world works with money. And we take that very, very seriously every day, and we're looking to basically question every assumption there is around what money is for, who it should serve, how the whole money system works, etc. And my first job is as a caddy, carrying golf bags for Wall Street traders in New Jersey in the mid-'80s, and I got kind of a first-hand view of what that world is like. And one of the things I always talk about is that I would ask these guys, and they were all guys because women weren't allowed on the golf course that I caddied at, and I asked them, what they did, because my dad was a sheets and towel salesman, and that was easy to understand because I used sheets and towels every day. And I'd ask them what they did, and there was always a huge pause, and they would have to kind of think, how do I explain what I do to this 14-year-old kid? And I think since then, I've basically been obsessed with all the questions around how does our money system work, etc. And so at RSF, we direct lending is perhaps our core competency, the main thing that we do. We have about $170 million in assets. We have 40 staff members and about a $67 million operating budget. And what we do with the $100 million of that money is we lend it out exclusively to social enterprises. So we are looking first and foremost at what is the social and or environmental purpose of this enterprise. And about half the organizations that we make loans to are nonprofits, and about half are for-profits, which I think is kind of indicative of where we are today, where there are so many more hybrid social enterprises, where there are many nonprofits that are developing more and more robust earned income strategies, and then there are more and more for-profits that are hard to tell from their nonprofit cousins because they're so mission-driven, and they literally would not be in business but for the social environmental mission that they have. And so those are the social entrepreneurs that we're looking to connect with. It's great to be up here with Kiva Zip, and you talked about community sourced, some other options, because our loans start basically at $150,000 and go up to $5 million. So it's great that there's a full ecosystem that's developing around, like the $5,000 to $50,000 level, because there's going to be a whole ecosystem that we need over time, and it's great to see it kind of being fleshed out. One other part of the ecosystem I'd love to see, this is the activist who put it like rabble-rouser side of me, is we were the first lender to Revolution Foods, which is based here in Oakland. And the past number of months, I've been privy, as I open up to the Wall Street Journal and New York Times, to see full-page ads that Citigroup is running with a Revolution Foods truck on there, bragging about their lending relationship with Revolution Foods. And the copy of the ad basically says, when Revolution Foods needed someone to take care of their capital needs and blah, 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 we were there for them. And of course, the reality is they were there for them once they got to be immensely profitable and had virtually no risk. Then they were happy to lend to them. So we like to be often the first lender. We like to try and be there. We have New Resource Bank and Beneficial State here today, who are two great local, regional community banks here in the Bay Area that we do participate with. But oftentimes we try to be there first, and we try to be catalytic in the sense that how much does our money matter? And that's what our investors are looking for. So we have 1,600 investors, only a couple of hundred of which are accredited or high net worth individuals and families. We have no institutional investors at all, period. So they're all human beings, and a couple hundred of which are accredited, and the 1,400 plus that are remaining are non-accredited because the minimum is $1,000 to invest in our fund. And think of it as an alternative essentially to a bank CD if you're an investor. So it's very low risk. We've been around 30 years. We've lent out over $300 million. We have a 100% repayment rate to our investors. We have a 2% cumulative loss rate over that period of time. And we have on the loans, and we have very strong reserves underneath the fund. So that's how you look at it, is if you have some money at I'll just pick on Chase or Wells or B of A or just to get it out there. If you have money sitting in any of those institutions, then I would urge you to take a hard look at RSF for some of those funds in like a CD, because the term of your investment is 90 days. You can get all or some of your money out every 90 days, so it's fairly liquid. It's very low risk, and the returns are comparable to savings account or CD at a bank. And then for entrepreneurs out there, as I said, in this main loan fund, our social investment fund, the minimum size loans we're making are $200,000, $250,000, on up to $5 million. And so if you're very early in your development as an enterprise, if you're in startup mode, probably debt is not the best idea for you anyway. You should be raising other types of capital. I'm going to talk about how to think about that, because you don't want to be paying out debt service right from the start of your enterprise. And so what we're looking for our organizations, social enterprises that have been in business for at least a few years with the same management team, a threshold of about $1 million in revenue, though that's not completely rigid. We need to have some visibility to what break-even is, if you're not break-even when you approach us. But most of all, what we're looking for is how deep is your passion and your commitment to the social environmental purpose that you have. And so we have some other funds, which I'm not going to talk about today, but the takeaways are basically that, and we've invested in made loans to many other companies here in the Bay Area, from MET, it's based here, to Guayaquil, lots of organizations in the food and agriculture arena. We make a lot of loans in the area of education and the arts, and then we have a broader bucket we call ecological stewardship. I'm out of time, or else I would go into a whole bunch of other dimensions of what we do, but that's basically a sketch. So for the entrepreneurs, those are some of the sectors we focus on, some of the criteria, and then for investors, it's rare you can find an opportunity to invest in 115 incredibly inspiring social enterprises with $1,000 in the impact investing space. Thanks.
I have a couple of questions. What is the most common reason that a business would not get funded?
So the most common reasons why an organization would not get funding. too early stage is probably the number one reason. That's a tough one for us because we see so many inspiring early stage organizations. And we try, if we have to say no based on that, we try really hard to refer people to all the growing number of options that are out there, a number of which are here in this room, like Cutting Edge or Keep a Zip or others. So that's probably number one. And then number two is they have to fit into our focus areas, those that I just mentioned. Number three, which is also a tough one, is if they don't have a good enough handle on the finances part of their business, at which point we do spend quite a lot of time pro bono in various forms of technical assistance or trying to help them understand what resources are available to them if we can help them. And a bunch of the loans that we've made that have been the most gratifying to me since I've been in RSF for the last 7 years are those where we couldn't make the loan initially, either because they were too early stage or because they didn't understand the finance part well enough to believe we could get paid back. The person we were talking to just ran with it and went to school wherever they could, scrapped, kicked the scrappy factor into high gear and figured out how to get to the stage where they could come back to us, like a year or 2 or 4 years later. And so there's an example of that in Richmond right now, a company called Nutiva that came to us, and we ended up having to say no initially, and then we made a $400,000 line of credit available to them. Now they need a $15 million line of credit, and they have about $100 million in sales. So that's it's always great when that can happen.
Awesome. It sounds like Impact Hub Oakland. We came to you a little too early. We'll come back. Can you let us know what is the rate, your typical rate of your loans? What do you charge for your loans?
Right now, the base rate of return, our base rate of interest that borrowers pay is 4.5%. And then we have certain risk premiums that come with that. A lot of the nonprofits or schools qualify for that. Some of the for-profits do too, but then sometimes we have to put a risk premium on it if we're doing an inventory or accounts receivable based loan that doesn't have a ton of collateral. If we end up with a lot of carpets or a lot of tea, there's only so much we can do with that.
And for the investor, the rate of return?
So the rate of return for investors right now is 0.25, a whopping 0.25%. So generally we track with interest rates, and I could go into how we set our interest rates, which is really fascinating if we have time. We have a whole community-based way of setting our interest rates. We bring representatives of our borrowers and our investors together each quarter to talk about what their needs are, and they basically advise us on what rate of interest the borrowers should pay and what rate of return the investors should get. But that's why I said it's really comparable to a bank CD. So we're calculating that it's roughly twice what you can get in a 6-month bank CD today at B of A, let's just call it.
And I'm thinking about Marco's talk and his example of working with a fund that was really ethical, seemingly really on the up and up, a really good company, and then you dig deeper and you realize that they're getting their carbon credits because they're clear cutting, and monocropping. The vetting that Marco really talked about, the real deep vetting on the social side. Are you all doing that, and how do you do that for the companies that you're funding?
Yes is the short answer. So of the 40 people we have, probably 22 of them are engaged in that kind of deep dive vetting on the social environmental mission. We do use the B Lab survey on the front end but that's the more kind of quantitative checkbox way of looking at. I urge you to go to bcorporation.net if you're not aware of who's aware of B Corps here in the room. Okay, just about everybody. Okay, so we use that on the front end, but then we have our own qualitative assessment also, and we spend an inordinate amount of time with the human beings who run the organization, as well as their suppliers, basically all their investors, all their stakeholders, and because we're very much relationship based, and we want to have a long-term relationship whenever we start with an organization. So we spend a ton of time on the diligence part, especially the social mission part of the diligence. And Jenny wanted me to tell you all that we have some of our own assets that we invest in. We don't invest in in public markets of any kind because we just don't believe in the system, frankly. So if you may not be aware, this is just keying off of a bunch of things Marco was saying, that two things real quick as far as rant on that. One is that you as a small individual investor, frankly, don't really matter to the markets. I don't want to be too jaded or cynical about that, but I kind of will at the moment, because 70% of all the trades that happen are happening through computerized algorithms, and you're not really providing growth capital to an enterprise when you invest in the stock market. You're basically trading paper with another seller, and you're not really providing any net new capital for that business. And the only things we want to be part of at RSF is when we're providing direct capital of one kind or another into an enterprise for however they want to use it.
Thank you. All right, let's get into RSF and Don Schieffer. So we have people in the back, right, Don?
Yes, we do.
Right.
So Catherine and Alex are back there. You can say hi to them.
Great. All right. So our next speaker is Johnny Price, who works with Kiva Zip. So Kiva Zip is an online platform, okay, that provides people the opportunity to actually loan directly to a business. And so this is direct loaning to businesses that you choose yourself. These businesses are publicly announcing that they're seeking funding, and and as I said, it is a loan. So I would like for Johnny, if you can explain to us exactly how Kiva Zip works, and I think if you could again go from both the business side as well as the investor side, we'd appreciate it. Thank you.
Yeah. Sure. Let me start by putting you on the spot. Has anyone made a loan on Kiva Zip? Yes. I'm noticing my fellow panelists here did not raise his hand. Sorry. Well, my money is sitting in Wells Fargo, so we're in. Well, thank you. And I'm not a very good public speaker. I'm probably going to drone on for the next 10 minutes, and we have a mobile site. So if you want to get your phones out and make a $5 loan while I'm speaking, be my guest. I will not be offended if all of you are iPhoning away. But that's the point, that it's very, very easy for any of us to make a loan on Kiva Zip. And you can do it for as little as $5. And it's crowdfunding. You guys know Kickstarter, Indiegogo. It's a very similar concept, but this is crowd lending. So we will make a loan of $5,000 or $10,000 to a small business owner, an entrepreneur, an artisan, a farmer. And that $5,000 loan might come from 500 people lending on average $10. Our loans are at 0% interest. So as a lender, you have no hope of any return. The maximum you can get back is your principal. And as a borrower, you don't pay any interest. You don't pay any fees. You pay back the $5,000 that you borrowed. It's beautifully simple. And if you're late on your payments, then there are no late fees. You just pay back the $5,000 a little bit later. So we launched, well, I should back up. Kiva Zip is a pilot program launched by Kiva. You may, if you haven't heard of Kiva Zip, you may know Kiva. We're a non-profit based over there in San Francisco. We launched in 2005. Since then, Kiva's made over 1 million loans to entrepreneurs, $500 million of capital loaned out all around the world. Most of those loans are made through microfinance institutions who act as intermediaries. So once we've crowdfunded the loan, we send it to the MFI, and the MFI then sends it to the borrower. How Kiva Zip differs is that we send the loan directly to the borrower. And it's also different in that on the regular Kiva platform, those loans are at the interest rate to the borrower that the MFI charges, whereas our loans are at 0% interest. So we launched Kiva Zip in 2011. Those differences I've already touched on. Another important one is that whereas most of Kiva is focused internationally in the developing world, Kiva Zip is focused here in the United States. We have 1 million lenders on Kiva, and they kept on telling us, this is great that I can lend to an entrepreneur in Uganda or Peru, but hey, what if I want to lend to an entrepreneur here in my own backyard in Oakland? So hence we launched Kiva Zip in 2011 to try and enable them to do that. We've made about 800 loans over the last 2.5 years to micro entrepreneurs, on average $5,000, crowdfunded by about 30,000 people like everyone that raised their hand earlier. So that's a little bit about how a crowdfunding model works. I wanted to leave you with 2 words that I think really epitomize what we're trying to do with Kiva Zip: community and impact. So on both words, I think I'm speaking on the right panel today. On the impact side, we are trying to expand access to capital for small business owners in America. So we see that there are 25 million micro-entrepreneurs in America, 25 million micro-enterprises, according to AEO. And last year, there were roughly 25,000 micro-loans of $50,000 and below made to those entrepreneurs. And we think that number is really, really small, and it should be much, much bigger. So we also see 8,000 small business loan applications rejected by banks every single day. And so we're hoping to radically, revolutionarily, wow, that was a difficult word to say, expand access and say, the financial sector might say that you as an entrepreneur, you as a small business owner can't access that microloan because you don't have the perfect FICO score, or you don't have collateral yet, or you haven't been in business for long enough, or you don't have the collateral, whatever it might be. We're hoping that a crowd of people like us can say yes, where banks are saying no. And the other way in which I think we're trying to have an impact is the 0% interest piece. There really are no fees, no interest rates for small business owners. So both in terms of access and in terms of the cost of capital, that's the impact that we're looking to have. The second word was community. We talk a lot on the Kiva Zip team about social capital. And it was really cool, I can't see him, but Alex from Community Source Capital as well. Love what those guys are doing up in Seattle. We see ourselves kind of filling very similar gaps in the market. But what we mean by social capital is, well, firstly, obviously, the loan is coming from a crowd of people. It's coming from a social group of people rather than one financial institution. And there are many benefits of that, I think. The first is, going back to what I said earlier about who can access capital. If you're a financial institution and you're lending $5,000, you probably want a rate of return of 5% or 10% or whatever it might be. And you're also, because you're lending such a large amount, your risk tolerance is very, very low. If you're an individual and you're looking to help an entrepreneur get the start they need, or you're looking to create opportunities for inner city entrepreneurs in Detroit or farmers in rural Arkansas, you probably, firstly, you're okay if you don't earn a rate of return if you just get your principal back. And secondly, you have a much, much higher tolerance for risk because it's $5, right? And so that's one of the benefits, I think, that the social element of our loans enables us to provide. Another benefit for our entrepreneurs is that as well as these loans being 0% interest, we're also connecting them with hundreds of potential customers, or hundreds of potential brand ambassadors, or people that can give them business advice. And we're very explicitly not providing them with the deep technical assistance that a lender like OBDC would provide, or many VC firms, right, will provide expertise. That's one of the value adds they provide to the businesses they're investing in. We're not doing that. We partner with organizations like Mandela Marketplace or UC that are providing those services, but we don't provide them ourselves. But we see the business advice and the assistance that we provide to our entrepreneurs is being broadly based and diffused and coming from our crowd of lenders. You might pitch in, you know, an idea about, oh, you should think about changing your logo in this way. I'm a graphic designer. Like, let me know if you, you know, could benefit from my services. That kind of thing. So that's another benefit of the social capital. And the last thing I just emphasize as well is one aspect of social capital for us is what we call social underwriting. So again, we see banks and regular lenders looking at conventional financial criteria and how they assess credit. So like I said before, your FICO score, your cash flow, your collateral, and we're trying to look past those metrics and look at the business owner's character. And earlier this year, we came up with an innovation that we on the team are really, really excited about. We call it a private fundraising period. And what it means is every business owner that applies for a loan on Kiva Zip, one of the parts of the application process is they need to get 15 people to lend to them on our website before we post them publicly on the site. And what that does for us is show that they have that entrepreneurial spirit, they have that hustle, that ability to market themselves and persuade their network of trust, their friends and family, to lend to them and get it started. And then we can leverage our crowd of 30,000 lenders on Kiva Zip to take that initial 10% or 15% and hopefully get them the rest of the way there. So social underwriting, part of that word social capital, which for me is, really reflects the community, that aspect of our program, which we're really excited about.
So I have a question for you around the stage of business. Absolute startups?
Yeah, absolute startups. About 25% of the loans we've made have been to pre-revenue startups, which I think is pretty awesome. Half of the loans we've made have been to businesses in their first year of operation. We really see ourselves, I mean, the loans are tiny, right? $5,000 or $10,000. Really, really small. And so the businesses that we're reaching tend to be very, very early stage, 5 employee or fewer micro enterprises. A lot of our borrowers also use Kiva Zip loans as part of their larger capital raise. So they might need $50,000. If they can raise 5 or 10 on Kiva Zip, that's part of the way there. They now need to raise less elsewhere. Community Source Capital does loans up to 50K, by the way. So check those guys out as well. But yeah, super early stage businesses.
And the ones that actually get funded in terms of repayment, what is your repayment success look like?
Our repayment rate is not very good. It's 90%. So that's a lot lower than most micro lenders. Although actually it's interesting, I mentioned before that on the Kiva platform we work with MFIs as intermediaries between Kiva and the borrower. And they usually charge 15% interest on the loans that they're making. Our repayment rate on our Kiva platform in the US is also 90%. So given we're reaching entrepreneurs that MFIs aren't reaching, because they're startups or because they have a damaged FICO score or whatever it might be, we think that repayment rate's okay. But obviously, fellow panelists might balk at 90%.
Not for that early.
Well, that's good.
And if you're not losing some money, you're not taking enough risk.
There we go. And also, our lenders are happy. It's up to our lenders. It's not our money. It's not our decision. It's up to our lenders, and they are telling us, right? Hey, if I'm supporting a farmer in West Virginia who has very little other options, then I'm happy if the repayment rate is 50%. Or if I'm supporting an ex-offender in Dallas who everyone else has turned their back on, then our lenders are telling us they're happy with that repayment rate, and it's about the impact rather than the rate of return. If you want a rate of return, don't come to us.
And how do you get paid? How does Kiva Zip if there's no interest?
Yeah, that's a great question. We're a non-profit. We're entirely grant funded. So one challenge we get, and it's a challenge I enjoy debating, is one challenge is, are we sustainable? Are we distorting markets through, subsidized capital? We don't have enough time for me to go into that, but if you want to debate me on that, come find me after. I love that question. The elevator answer is we get about 2/3 of our revenue as Kiva. Well, 1/3 of our revenue comes from grants, from foundations and corporations. Google.org recently gave us a multi-million-dollar grant to keep doing the work we're doing. 2/3 of our revenue comes from our crowd of 1 million lenders. And so that's a very broadly based, very reliable, predictable revenue stream, which I would argue is pretty sustainable. And we've done $500 million of loans on 2/3 on that revenue stream over the last 5 years. My goal at Kiva Zip is to get that broadly sourced crowd-based revenue entirely covering our costs, so that we're no longer at all dependent on grant funding, and any grant funding we do get, we can use to invest in infrastructure and grow the program. And right now, our lenders roughly tip us about 5%. So if they make a $25 loan, roughly they give us $1.25 as a donation on top of that to help pay my salary. So on a $5,000 loan, that means we're getting $250. If we can get our cost per loan below $250, I'd argue we're pretty sustainable. And our costs right now are about $500, but they've been coming down sharply for the last 3 years. And so I can see a path to how our cost per loan, on average, can be less than our revenue per loan, and then I don't know if we're a for-profit. I'll ask Jenny the answer on that one. All right, we're good.
And so we have about, how many minutes do we have? Any? 0? We're down to. And I just, while we're checking the minutes, I want to also announce that Impact Hub Oakland is in the process of becoming a trustee. So we are in the application process, and so you can come to us at some point soon. Hopefully we'll finish that process and we'll be a conduit between
Thank you. The trustee is how we vet, that's another part of our social underwriting, how we vet the loans. So Youth Seed is a trustee, Mandela Marketplace is a trustee, Impact Hub is becoming a trustee. The City of Oakland is actually a trustee. They've endorsed 3 minority women entrepreneurs for loans. It was really cool when we got that partnership. Libby Schaff, who's on the council, has been really instrumental in helping us push a resolution through and helping us grow Kiva Zip here in Oakland. So that's how we're finding these entrepreneurs and part of that social underwriting process.
All right, so we have a few minutes that we're going to put questions out into the audience. So I'm going to give them this mic and standing in the back.
Oh, way to that. There we go. I'm coming.
This is active in Middle Tennessee, and I'm wondering what your process is for pipelining more U.S. cities.
Yeah, thank you. Firstly, I got married in Nashville, Tennessee. My wife is from Nashville, Tennessee, and my in-laws live there, so let's make it happen. We are rolling out Kiva Zip city by city throughout the US. So we have a program called the Kiva City program, where we will launch in a city. We usually try and get grant funding to help cover our costs to do that, in the order of a couple of $100,000, which I think, looking at other micro-lending programs, is not that much money. We have one partnership with Launch Chattanooga in Tennessee that I know of. I think that's the only one. But basically, if there's pull from the community, like there really has been here in Oakland, and so we're going to be rolling out Kiva City here in Oakland in September of next year, which we're super stoked about. But if there's pull from the community, from funders, from trustees, from the city government, from local community activists, then we want to be there. And what's brilliant about this program, we launched it in Detroit. We've had a lot of success in Detroit. The Bay Area is our biggest market. We're launching in New York, the metropolis of New York. We launched in Little Rock, Arkansas with Bill Clinton And we made as many loans during our launch event as the SBA said microloans were made in the entire state of Arkansas in the previous year. So whether it's, you know, a sleepy town, I hope there's no one from Little Rock here, whether it's a sleepy town like Little Rock or, you know, a metropolis like New York, we're seeing that these loans are really, like, entrepreneurs are crying out for these loans. So let's make it happen in Nashville.
Yeah, hi Johnny, I really like your platform. I mean, we've continually faced this hurdle. You know, we made our product by hand, and we know how to make it. We have our patents issued, and we're trying to, and it's a 5 bottom line benefit. If we make it here in the United States, it creates 1,026 jobs. I mean, it has all these environmental aspects. It's really good. But the conventional system, the banks and whatever, the other systems, they always say, well, you have to have this $1 million, $3 million, or $5 million hurdle. Well, in order to get that, it involves making us, continuing to make it by hand. Every single time we make it by hand, because it's an electronic product, the costs are exponential. So we cannot meet it by hand. And so this is your system doesn't have that criteria that traditional banks and other social responsible do. They say they're sustainable, but they're not sustainable.
Yeah.
What they are do is they block progress. And
so that's what we're here to try and educate.
you have a much you have the future versus other so-called sustainable things really aren't. They're status quo.
I agree. We're very small. We probably, you know, couldn't do a loan that big. Community source capital do larger loans, but we're only up to 5 or 10,000.
Good afternoon.
I just want to make sure that you're clear. We're asking questions to both, all three. Okay, anyone up here on the panel.
Good afternoon, Fanil Geronimo from Mountain View. Thank you, all just great participants, and I just made a loan, so very happy with that. It's a really easy process. That's one of the first things to look at. I do some investment. I'm always looking for interesting companies, so kudos to you. I had a question on benefit corporations. They're relatively new, and they're now legal here in California. I was wondering on your perspective about lending to benefit corps. Is that different than to nonprofits or to the traditional company?
Question for me?
Yes, please.
I should say, first of all, that RSF itself is a hybrid social enterprise. So our mothership is a nonprofit, but we have 4 nonprofit entities and 4 for-profit entities underneath RSF. One of the for-profit entities, RSF Capital Management, was technically the first public benefit corporation in the state of Delaware. And so we don't show preference to benefit corps or B corps per se, but we, of the 115 loans that we have, at least, I should know this exact number, but at least 20 of them are to B corps and benefit corps. So we do see it as a standard and as a strong indicator of someone's intent and practices. Otherwise, you can't be a certified B Corp or a benefit corporation. Is that what you're asking? Like how we use it as a screen?
Yeah, like for instance, foundations these days, they're not used to getting benefit forms, right?
Mm-hmm.
Like 501c3.
Right.
So we're seeing a lot of changes happening
Yes.
across different industries about funding benefit corporations.
Yes.
So I was wondering if the lending side is different or the same process that we do for the other ones.
Well, we do the same process, but I would say a benefit corp or a B Corp has an elevated position at the very beginning for us, for sure. Full disclosure, I'm on the B Lab board, and I could talk for another 2 hours about B corporations. But so, yes, is a short answer.
Yeah, this is just kind of an observation for Johnny. You might already know this, but Maimonides was probably heard the name. He was a great rabbi in the Middle Ages, and he wrote a lot about money. And one of the things that he said was that the 0% interest loan is the highest form of financial assistance. So for what it's worth, it sounds like Cuba's is Talmudically correct.
I'll take that.
I'd highly recommend a book, by the way, on that theme, a specific chapter of a specific book on that theme, a book called The Gift by Lewis Hyde. Chapter 7 is about the history of usury, and it goes into some of those themes around. I think we're going to see a lot more pay it forward zero interest loan initiatives in the years to come.
Hi, my name is Chuck Brown. This is a question for, I think, Jenny and Johnny. We heard a little bit about Kiva Zip earlier during Marco's presentation when he described the 0% interest for these loans, that Kiva Zip may be flying under the SEC laws is the way he described it. So, Jenny, can you speak to that in terms of what did Marco mean exactly by that, and are there any legal obstacles possibly with the Kiva Zip model in the near future?
It's an awkward question because I don't want to say that what Johnny's doing is illegal, but I think it's unfortunately the definition of a security can be a little bit unclear, especially under state law. Some of the states have a much broader definition of a security. In California, there was a famous case where people were building a country club. Thank you. And they pre-sold memberships in the country club, and that was seen by the state Supreme Court as a security. So unfortunately, it is a little bit, it's hard to say for sure, but there's things that are kind of in a gray area. But a lot of those things have been happening for a long time. You see a lot of things on Kickstarter and Indiegogo that could potentially fall within that broad definition. So, but they haven't had problems so far. They have an amazing staff attorney who's really smart. So I think they're good. So yeah, just to get super clear on that, the idea that they're working under is that if there's no return on the investment, all you're getting back is your principal, that it's not going to really fall under the definition of a security, because the whole reason for investing in a security is to make a return on your investment.
Yeah, I probably can't add much more than that, except to say there was a report from the Government Accountability Office. Have you seen that? That covered Prosper, Lending Club, and Kiva. This was back in 2009, and whether those three companies needed to register with the SEC. And Prosper and Lending Club was said yes, they need to register because they're offering a rate of return to investors, and therefore it's a security. And the GAO report said Kiva does not need to register with the SEC because they're offering no hope of any financial return to investors. So I will forward you that report, Jenny.
I also just want to add that Impact Hub Oakland, when we did our Kickstarter, we were pre-selling memberships. So we had this conversation about the country club, blah, 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 blah. And we went forward with it, with our Kickstarter. How many of you know our Kickstarter campaign or saw it, or, right? It was great, right? And so we went on with it, but we did have that conversation with Jenny as our lawyer.
That's my job to tell you the worst case scenario.
So, two-part question. Don, first of all, you mentioned inventory financing before. I'd like to know whether that includes in any way you all tracking receivables, invoices, that type of thing. And then the second part of the question is, when are you all moving to Oakland?
Good questions. So yes to the first one on accounts receivable, as well as inventory. We do different kinds of lines of credit. And we explored moving to the East Bay Outlet. Since I live, as I said, a couple miles from here, I have a vested interest in moving to Oakland. And I'm still chipping away at the rest of our staff, a couple of whom are in the back. So I think it's unlikely, but it's possible. We've been in the Presidio since it was decommissioned in the mid to late 90s, and so appreciate the nudge.
We've made about 50 loans to micro entrepreneurs in Oakland over the last 2.5 years. Through the City of Oakland, through Centro Community Partners, through Unity Council, through Mandela Marketplace, through Youth Seed. I think we have about 20 trustees in Oakland, and we're just getting started. But yeah, we're already here. We're already supporting entrepreneurs in Oakland. We're really, really excited to do it. I was actually on a NBC Bay Area TV show the day when we launched in Oakland, and for some reason the caption underneath got it wrong. And I said, oh, I just love how people in Oakland have this sense of community. Like they say, I'm from Oakland, and the caption underneath said, just, I'm from Oakland, said Johnny Price, Senior Director of Cuba Zip. So according to NBC Bay Area, I'm one of you guys. I'm an Oaklander. Don't be deterred by the accent. It's fake. I just use it to get Nashville girls.
Hi, I'm Brian Wallace. I'm a successful borrower on Cuba Zip, so thank you. Baybox was my trustee. I had a question that may be more specific to Cuba Zip that maybe you guys could answer. And I'm wondering about the middle ground between a $5,000 and $10,000 loan and when my business is 2 years old or wants to get $250,000 or $500,000 or more. And if you see any kind of flexibility in the short term or in the long term with other platforms, or maybe Cuba Zip increasing your loan cap, or where that kind of conversation can go.
That's a great question. I love that question because there's a big gap between RSF and Cuba Zip, right? I think one of the answers, I should be on commission. I still don't know where you are, but this is the third time now I've mentioned community source capital. One of the great things about working for a non-profit, you can promote your competition. It's so fun. Yeah, those guys do loans up to $50K, and they're coming to California, so check them out. There's awesome MFIs around the Bay Area, so Working Solutions. Most MFIs that I know of say you have to have been in business for a year or two, you have to demonstrate your cash flows. So what we see ourselves as doing is enabling a small business owner and entrepreneur to get started so that they can then demonstrate those cash flows to an MFI an opportunity fund, I think, do loans up to $250,000, OBDC.
Opportunity fund is 100, we're 250.
Okay, so OBDC does up to $250,000. They're a lender here in CDFI here in Oakland. We very much see ourselves as the bottom rung on the ladder and just helping entrepreneurs get started. And we hope that, yeah, like I say, with a couple of years of repayments on a Cuba Zip loan, and now you've got the cash flows, you can then qualify for a larger loan from a CDFI or an MFI or community source capital.com.
Yeah, I think we could include Northern Community Loan Fund in that list of those that are. What's Northern Community Loan Fund's sweet spot of amount?
We get up to $2 million.
Okay. But I think one other thing I'd mention is that two things we're doing at RSF. One is we have a PRI fund. So for foundations that want to put funds at RSF that want to do what are called program-related investments. So I'll explain more of that to you offline rather than explain it up here if you're interested. But we're able to offer $100,000 to $250,000 loans through that PRI fund, which is a separate fund that we have. And then we also have a series of new philanthropic funds that are being opened at RSF for specific themes. So the first one's on resilient local economies and regional food systems. That started as a $4 million fund. We've funded 40 projects and used $2 million of that so far, where we're doing loan guarantees and convertible debt and even direct equity using philanthropic funds that then will get recycled back into that same fund for more loan guarantees and more. So that's something to keep in mind. We only have one of those up to date, so it's been the pilot fund, but we're going to have other. It's in food and ag, so master chocolatiers, take note.
Hi, yeah, I have just finished The Gift, Gone, and other books, and I am also kudos to Kiva for doing the zero interest lending. But it's made me curious actually about how Cuba Zip, as kind of a subgroup of Kiva, is reconciling, because I know you're going through the MFIs for the global program, and there's been some kind of interest around interest rates of those, and go up to as high as 23% and have been kind of seen as predatory, and it's in the developing world. And I'm just wondering if what you guys have done is impacting the organization, and if there's a way to do your global program more similarly to how Cuba Zip is operating.
That's a really fascinating question. I could wax lyrical about now, based on the last 2.5 years, because what we're doing with Cuba Zip is, this is like inside of baseball maybe, but it's, what we're doing with KeepZip is disrupting the Kiva model, right? Because they work with MFIs, and with KeepZip we're coming in and saying, well, we're going to bypass MFIs and lend directly to the borrower. Is this being recorded?
It's openly in Kenya with KeepZip, right?
We are, yeah. So it's been a real challenge actually, trying to disrupt the business model of the organization from within. If you guys have read The Innovator's Dilemma, you'll know what I'm talking about. Lots and lots of learnings. But yeah, we're in Kenya with KeepZip. We're doing loans at 0% interest in Kenya, and I think most MFIs in America will charge about 15%. Most MFIs in Kenya will charge about 30% because the loans are a lot smaller, and so, but there's fixed costs, and so you need to charge more to cover their costs. And I think the microfinance industry worldwide has done a great job at being sustainable. The microfinance industry in the US, I think, could learn a lot from the microfinance industry worldwide around sustainability, but you're right, interest rates are high. And so with KeepZip in Kenya, we're making loans at 0% interest. We're using a mobile payments platform called M-Pesa to send the loans directly to entrepreneurs' mobile phones. And you can make a loan to a Kenyan entrepreneur on KeepZip today, and you can send them an email and they get it as an SMS and they can respond via SMS. So now just as you're providing emotional encouragement and support to an entrepreneur here in Oakland, so you can do the same thing for an entrepreneur here in Nairobi. I think it's the most exciting thing happening in the whole world of international economic development, but I'm biased.
All right. We are at the end of our panel and our Q&A. Let's give our, one more thing. Hold on, Jenny wants to say one more thing. Sorry.
I just want to make sure that, that we remember that this panel is about platforms and nonprofit investment funds in general. And there are lots of different kinds of those. So please look at, at the handout. It gives some examples. I feel terrible that I forgot to include community source capital on this list, but if anyone knows of any other platforms where regular folks can go on and invest, let's definitely make sure we all know about those, because there aren't very many right now.
Great. Thank you, Jenny. Thank you very much, Johnny, Don, for a wonderful panel. Let's hear from you. All right, this was wonderful. So we are going to transition now into a very exciting part of our